According to supply managers in the 9 Mid-America states, how is the economy performing?
Not very well, at least the manufacturing economy. This, of course, comes from Creighton's survey of Mid-America, the 9 states stretching from North Dakota and Minnesota in the north to Oklahoma and Arkansas in the south. The number, which ranges between 0 and 100, with 50 being growth neutral, has been up and above, over and above 50 growth neutral. Now it's 49.8, which is obviously below growth neutral 50.0, and that's down from August's 50.5. Now what it's doing is just bouncing up and over, back and forth between growth neutral and below growth neutral. Trade numbers are just really showing weakness, and that's where the weakness is coming from. And this, now again, this is manufacturing. These are supply managers in manufacturing, what's called sometimes the PMI, Purchasing Management Index. And you can compare these across the globe. You can compare them to the U.S. number, which comes out later on this morning. And of course, it's going to be not that good. We're seeing job losses there. And if you look at the import reading, it was down to 34.8, and that's from 35.9. Obviously, well below growth neutral. These tariffs are really cutting into imports and exports. Exports are 43.3, and that's down from 39.5 last month. So we're seeing some retaliation. Let me give you an example. China just purchased soybean from Brazil. Now, they have not bought U.S. soybeans since May. Now, that's very unusual. They're retaliating against our agricultural sector, and they're retaliating against other sectors. Now, this is manufacturing. They're also retaliating against manufacturing, and they're not the only ones. So that's what's going on there. Now, if you take manufacturing exports, down by 3.1 billion. That's 2025 versus 2024, and that's a 5.5% reduction. Not good. This now the president is sticking to his guns there, so to speak, and I'm on the other side of that equation. Sorry about that. Economists are big free traders and open markets, but 4 out of 5 of our supply managers indicated that tariffs were pushing up prices. Obviously, that's not good. Inflation's above the Fed's target. So let me bring up a chart showing there. You'll see in beautiful Creighton blue there the Mid-American region, and this is again for September. And you see there U.S. number comes out, and it's going to be below growth neutral, maybe a little above growth neutral. Does it really matter? The manufacturing economy is slowing down. And there you see in black, that's the rural Main Street survey, which is more agriculture. And you see it well below growth neutral. We're seeing some pain out there in rural America, and that's really important for this part of the country. And that's being spilled over into the non-rural areas, and obviously Omaha, for example, where I live and do business, but I hopefully do business all over the 9-state region. For that matter, I'd hope all over the U.S. So that's it for the summary at the high level of the overall index, the PMI, what we call the Business Conditions Index.
What were the hiring trends?
Not good. I hate to say it. September hiring index is 44.9. That's getting down into recessionary ranges. And of course, manufacturing is dipping below and into and out of recession. And that's down from August's 45.6. And if you go back to July, 45.4. And as many of you know, in June, the U.S. lost jobs. Now, this is overall jobs, not just manufacturing jobs. When you turn to the overall non-farm economy, this part of the nation, the 9 states, have added 118,000 jobs. Not many. That's 0.8%. Then you look at the U.S. and again, non-farm, not manufacturing. This survey is a survey of manufacturing. But let me talk about the bigger economy, and that U.S. is 1.466 million jobs added. That's only 0.9%. Not good. Manufacturing, now turn to manufacturing. This part of the country has lost 3,800 jobs. That's the 9-state region. And that's about 0.3%. The U.S. has lost 78,000 manufacturing jobs, and that's 0.6%. So we're losing jobs, losing manufacturing jobs. And I know I've raised my voice there, but we need to raise our voice about what's going on in manufacturing, because again, manufacturing and agriculture depend heavily on trade, and trade's not good right now.
What inflation trends are you noticing?
Inflation's not good. Now the index is elevated, meaning it's just inflation's holding up much stronger than we'd like to see it. The price gauge declined to 64.1, and that's down from 64.9 in August. Impact of tariffs, not too much impact on tariffs. We're seeing it in terms of impact. 60% said not much impact. Moderate impact, 22% said moderate impact. Significant impact, 18%. So you see there, when you put it all together, tariffs are having an impact. Mostly at the wholesale level. We haven't seen it at the retail or the consumer level. Keep an eye on the month-to-month changes. The CPI, all items, about 3.6%. The last 3 months annualized. That's what we're seeing. And core, that excludes food and energy, 3.2 annualized. And then you turn to the PPI, which is analogous to what the Creighton survey is tracking. The last 3 months, 2.8 annualized 3 months. And the core, again, excluding food and energy, 3.6% annualized. All that is saying, you put it all together, inflation is well above the Federal Reserve's target of 2%. So again, not where we want to be. And again, what we're seeing, of course, is a slower economy, and also inflationary pressure is a bit stronger than we'd like to see.
What is the economic outlook?
Outlook is not good. Depend, of course, a lot on what happens with Congress and the president. The shutdown, which is slated to begin Tuesday at 12 a.m., Tuesday night, I think of Tuesday night. That shutdown, it's going to be it'll have a significant impact. Look what's going on with gold and silver prices. Up, up, up. What is that? Risk are up, 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 up. So, and what we're seeing, and I haven't talked about this much in this video over the last year, we're seeing physical dominance, that FISCAL, physical dominance. That means the Fed's reducing interest rates. They're going to reduce interest rates on the 28th and 29th. However, monetary policy's fallen. It's not having much of an impact. It's the federal government. The federal government, fiscal policy, they're running a deficit of $2 trillion to $3 trillion this year. That swamps any impact that the Federal Reserve can have. So, and also, if you're out there expecting these cuts to bring down mortgage rates, not so much. Mortgage rates have remained elevated. Why? Long-term rates are not set by the Fed. They're more set by federal spending and what goes on outside by investors globally. Keep an eye on the Federal Reserve's balance sheet. Now that's again, just go to google.com and go Federal Reserve balance sheet, and it'll take you there. Look at that. That's where the federal government, what we economists call monetizing the debt, where nobody wants to buy the debt, lend to the U.S. government. Now, obviously some do, but it means fewer and fewer. And so what happens? The Federal Reserve lends to the U.S. Treasury, and that's what we're seeing, what we may see. Now, there have been quantitative tightening. I expect that to change to no policy, and then maybe even quantitative easing. The CPI month over month, PCE, Purchasing Consumption Expenditure, what's that one? That came out last week. It was not good. I mean, investors saluted it, but the investors salute everything. I mean, if it's not downright hog wallowing bad, good. They're whistling past the graveyard, but so should they. The federal government is now, again, fiscal dominance, and it looks like there's no end. Now, we'd wait to see. The Democrats are saying, Mr. President, you've got to fund some of this, what you defunded, and we'll see whether they do that or not, and that's mostly Medicaid funding. So watch that. Long-term rates, as I said last month, moving sideways to a bit up. Short-term rates moving down, so if you want to refinance your house, yeah, that's coming down. So home equity lines are coming down in terms of rates. But keep an eye on the bond market. That's where the grown-ups play. I'll say the young ones, the kids, play in the stock market. And when I'm there, I'm playing, meaning I don't know exactly what to buy. I'm listening. Apparently, I'm listening to the wrong people, the wrong advisors. But in the bond market, we economists do a lot better there. The yield on the 10-year Treasury, keep an eye on that. That's up to 4.15%. It was about 4.01 when the Fed cut rates. So you see 14 basis points, 14 100ths of a percentage point increase. What does that mean to mortgage rates? An additional 14 basis points, or 14 100ths of a percentage point up. Keep an eye on the ISM reading, which comes out later on this morning. That number is going to be below growth neutral. If it's not above growth neutral, it'll only be slightly above. Price of a barrel of oil, it's been heading higher a bit. That's sort of a warning signal. Warning more inflationary pressures at the same time. The labor market's not looking good. Keep an eye on the employment report, which comes out this Friday, first Friday of the month. If that one's not good, which I don't expect it to be, now what is not good? Below 50,000 would be, I would call it more than not good. It'd be bad. I'll call it bad. If it's above 100,000, that's okay. Above 200,000, then the Fed is going to get scared about inflationary pressures. Junk bond yields. Tricolor. Listen, Tricolor just went out of business, bankrupt. They're defaulting on their loans. Tricolor, big number. And they're defaulting on their AAA bond yields. AAA, are you kidding me? I don't know. Maybe I got that wrong, but that should be, well, they are junk bond now yields. And watch gold and silver. Gold is now approaching $3,900 an ounce, and silver $50 an ounce. And we're going to see those inch higher as the dollar reduces its value. Less and less of a dollar being reserve currency, but it's not just the dollar. Globally, we're seeing these what's called the currencies of the U.S. Those dollars, those yens, those euros, all those currencies are diminished in value as gold, silver, cryptocurrencies increase in value. So that's it for the month of September. Here we are on the first business day of the month. Ernie Goss here, and we'll see you next month, first business day of November, and we'll see what happens in the month of October until I see you again the first business day of November. May your economic cup runneth over.